Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the September investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weisse, about what's going on in the markets and investment universe we think you need to know right now. Bob, just a few more months left in the year.
Yeah, it's September. It's been overall a good year looking at returns, but not without some bumps and things to talk about. So I think we have a good agenda for today.
Yeah, absolutely. You usually start running through the numbers for us. So where are we year to date with the different asset classes if people have been enjoying their summers and not watching it as carefully as you do?
Yeah, so I'll run through it. Looking at US stocks, so the MSCI USA total return index year to date up 9.88%, so generously around that to 10. For the year for US stock market, the 1 month return is 2.94%, so about 3% in the last month, so it's been a strong month. Looking overseas, the MSCI World ex-USA, so developed markets excluding the USA, year to date up 21.29%, and
Wow.
last month 3.6% positive. So very strong return from developed international markets. And looking at the last slice of the global equity pie, emerging markets, the MSCI Emerging Market Net Total Return Index is up 19.69% year to date and 3.26 over the last month, so close to 20% from emerging markets. So US coming in strong around 10, overseas markets coming in around 20. So on the equity front, great year-to-date returns. Last month's been good. And then looking at fixed income, the Bloomberg US Aggregate Bond Index, which is mostly US investment grade bonds, is up about 4.7% year to date and 0.14% over the last month. So a pretty healthy return from investment grade bonds, getting 474 through the first 9 months of the year. So that's been good to see. Wrapping it all up, looking at the MSCI ACWI net total return. So that takes the three equity slices, US, developed international emerging markets, and weights them by market capitalization. The year-to-date return for the ACWI is plus 13.53, and over the last month, it's 3.14%.
All right. So, Bob, people have been fixated on the 10-year yield lately. And just a reminder for our listeners, why is the 10-year yield so important? And what have you been seeing activity-wise in it, as I believe it's moved around a fair amount?
Yeah, there's with Treasury bonds. First, Treasury bonds are known as the risk-free rate that people use to anchor if you're setting other lending terms, typically like mortgages, for example. So it's always like the Treasury yields the base rate, then there's a spread above the base rate, and you can look at short-term Treasury bonds like T-bills. You can go intermediate, longer term. There's different spots in the yield curve, and the 10 years kind of in the middle. It's not the 30 year and it's not a T-bill. So it's just gained general popularity as the most common treasury bond quoted. It's the closest to what mortgages are used. Because even if you take out a 30-year mortgage, well, it gets a little complicated because you're paying principal and because people refinance, it actually behaves more like a 10-year. So basically, a lot of market participants look at the 10-year, and it has been a bit of a seesaw year with rates. Yields were going up, and then they fell as people, got concerned about growth. And right now we're sitting around 4.25 on the 10-year. The market's pricing in 1 to 2 rate cuts later this month. So it's about a 91% chance of a 25 basis point cut and about a 9% chance of a 50 basis point cut, 0% chance. This is using the Fed Rate Watch tool, but looking at future contracts. But the market is expecting cuts, and it's just as a 1 or 2, and that's what's priced into the 4.25. So it's really kind of a tug of war, where on one hand, yields are being pulled down by expectations for rate cuts, And on the other hand, yields are being pulled up by expectations for inflation not abating, and that the inflation concerns remain, and some of the CPI, PCE prints are still a little higher than the Fed would like. And I think maybe the next topic for us to touch upon is Treasury debt levels, and some people are concerned with those, and that pushes rates higher. So you've just got this tug of war, and that's how markets work. And equilibrium's around 4.25 right now.
So that push and pull, I think, also connects to Jackson Hole, the meetings that were last week. Where coming out of that, there's a lot of talk about what direction policy should go because there's weakening in the labor market, but inflation is, I think, as you used before, sticky, right? And recent prints are not as well. We're not headed to 2% anytime soon, right? And that's the Fed's target. So you mentioned the rate cut odds? They're obviously factoring things like that in, but there's some concern about stagflation, and it's a lot of people like to bash and criticize the Fed. They do seem like an easy target, and we engaged in a tiny bit of that last time. But it is probably difficult when you're seeing inflation higher than where you want and a weakening jobs market to know what direction to go.
Yeah, so looking at so Jackson Hole is a big event, and the Fed chair gives a speech traditionally, and it's moved the markets over years. Sometimes they come out and say things that it's news, and this was a timely meeting with where we're at and the potential for rate cuts coming. So in reviewing Powell's speech, the two topics basically that you want to kind of check his and the committee's pulse on is the economy and jobs. Where you've seen that, is it hot, is it cold, and inflation, how concerned are you about inflation? And what he said about jobs is he quoted the July employment report that we talked about, I think, on the last podcast, where Trump fired the person in charge of releasing the jobs report because the adjustments were so severe. So over the last 3 months, the average new jobs created, and this is what Powell quoted, was 35,000 a month, down from 168,000 a month in 2024. So he cited that as a concern on the jobs front. So from 168,000 down to 35,000 a month. So that's a concern on the growth front. And then what's probably the most interesting line for me from what he said is, this is a direct quote here: "A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level," end quote. So that's what Powell said about the tariffs. So we talked about that a little bit last time too, on like a different podcast we listened to, where there was a debate. If the price level shifts up and it's a one-time shift from tariffs, is that inflation or not? And it could be sticky, as you said. But Powell said a reasonable base case is that it's not sticky. A reasonable base case is it's a one-time shift. So there he's kind of saying you could see it in the metrics, the PCE, CPI, it would catch inflation being above 2. But if it's just a one-time shift, then I would think if you were to elaborate on that, you'd say I'm not really concerned about it because it's not inflationary. So you take those two statements that I just took the excerpts from the longer speech, and there's some concern about the jobs market, and the reasonable base case on inflation is not to be concerned. So you add all that up, and the calculus is probably a more dovish, accommodative Fed with lower rates.
So we get to a phrase which we've used before on the podcast, the whole soft landing phrase, and it's funny that we're still maybe litigating whether this inflation fight that began a while ago will end with a soft landing or not. But is that still the question that markets are processing, or one of the questions that the market is processing?
I'd say on that topic, they landed the plane. They rose rates. They didn't break anything severely. 2022 was messy, but um, I think I think they did it. Yield curve inverted, a recession didn't follow, and now they could leave rates at this level for a long time. We're more at an equilibrium level of rates, like a long-term average, rather than a outlier level on the high end. So I think we're past that. They rose rates for a period of time, and it didn't cause a recession. And inflation, I mean, 2 to 3, it's close to target. I suppose you could say, well, they haven't landed the plane yet because we haven't been getting 2.0 prints consistently. But I'd be more inclined to say that it's been good enough for long enough that I'd give them a victory on this.
So I'm not hearing strong concerns about the economy, and I've known you for a long time, but there may be some concerns and a couple topics we wanted to talk about. I think one came out of a listener question related to ultimately valuations. And then, as you alluded to, we were going to discuss whether we should be worried or whether the market should be worried about the fiscal situation. So I'll leave it to you to pick where we go next.
Yeah, maybe just the listener question. I've been in a few client meetings, and there's a theme of questions and reactions that I'm seeing from clients, and it causes me to get into behavioral finance lectures. So I figured I'd give our listeners one. But the age-old, line of "Don't let the tax tail wag the dog, buy low, sell high." And past performance is not indicative of future results. Things that people know and have heard a million times. But I've seen clients who maybe have individual stocks, maybe a corporate stock purchase plan, and they've done really well in it. So there's large gains. And if they need cash, the question they've asked us is, well, I don't want to incur gains. Maybe can I take a margin loan for a cash need rather than selling stocks because I don't want to pay the taxes. And with where valuations are now, especially, I've just seen people over time avoid selling stocks when that's the textbook right thing to do because they don't want to pay the gains. And you know what happens? You have a market down and those gains go away, and then they sell the stocks and they don't have to pay gains. And it's just a really sad thing to see. So don't let the tax tail wag the dog. Don't shy away from paying capital gains. There are things we can do, different strategies to help offset that, which we've talked about previously. But in general, when you have winners, especially with where valuations are now, focus on discipline and realizing the gains because it's good to be in a position where you have gains. And we could very well see a correction from these levels, and then the gains go away, and then you can sell those positions with fewer gains, a lower tax liability, but that's not a good thing. So be happy that you have the gains, you've done well, and book them. As opposed to, like in this client's case, they're looking to lever the portfolio to avoid taking gains after a very healthy run in the stock market, which is not what I would consider wealthy behavior. And the other kind of tangent on that is clients looking at different accounts that may be positioned differently. And if they need money, taking money from the account that's performed the worst, which is the one that's heavier in bonds, and saying, well, that stock account, it's doing great. I don't want to touch that. That's the winner. That's the faster horse. So let's let that one keep doing its thing. And it's like, no, that's kind of the opposite of what we want you to be thinking. Buy low, sell high. That's the one that's been hot. So it's the right one to trim rather than trim your defensive holdings right now. So maybe the underlying tone is we are a little cautious with markets. It's not based on politics or debt levels. It's based on valuations. And valuations, especially in the US, are pretty high right now, which we've talked about previously. But the stock market has had a good run. So don't let that good run of past performance change your behavior so that you become, adverse to selling, taking profits if that's the right thing in your case.
Well said, Bob. And I think on some of those examples, in particular, when it's a concentrated position or a concentrated portfolio, there's just a risk management element on top of what you're saying that's being ignored, right?
Exactly.
Yeah, with some of those big names that have done extremely well. So I shared with you a Goldman Sachs research report on U.S. fiscal worries with the headline, "Is this time different?" And I wanted to get your thoughts on it and have a little bit of a discussion because coming off of the OBBBA, the One Big Beautiful Bill Act, there were, a reset of concerns around the deficit. Now people have been calming down a little bit because they've seen the tariff revenue that's going to come in potentially, unless this court case keeps going in the wrong direction for the administration, where the tariff revenue will potentially offset that portion of the deficit that will be attributed to that act or come close. But, we've been talking about this as professionals for 15 years, the entirety of our careers. Is this just more noise, or are there, legitimate investment implications that people should be wary of as it relates to the U.S. fiscal situation?
The last part's a tricky question. I think that the short of it is it's been on the back burner as a risk, but that risk, like when you invest in stocks, there's risks. Like geopolitical risk has been a kind of front burner risk for better part of the last 20 years. Economic risk is obviously a front burner risk. And I would more simply put it that it's going from a deep back burner risk, like one of those things that you can talk about. And yeah, that could be an issue someday, but doesn't really get priced into. I think we're moving to a world where federal debt is a front burner risk. And I think we've seen it in the last few years as rearing its ugly head, like 2022, when interest rates shot up and stocks went down. So you had a year with both negative returns in stocks and bonds to the tune of double digits in each, which doesn't happen too often. So and there have been other little instances where treasury yields have ran up from many, I think, panics on debt. So I think it's becoming more of a front burner risk, and risk happens. So it's just something that I think investors need to be tuned into and diversify around. So it's a real risk that you need to manage. It can't be, it shouldn't be the central focus of your portfolio. So your investment strategy is centered around navigating this topic, but it's one of the many risks that investors should definitely be tuned into and aware of.
And it's always funny with some of these, the people that they interviewed, Ray Dalio, Ken Rogoff, Neil Ferguson, people who I think have been pretty vocal about this topic for an extended period of time. And you would think once you're asking them, where the answer is going to lead.
Yeah, as soon as I saw it, and I think it's, is this time different? An interview with those three people, it- I knew what the conclusion was going to be. That they picked probably the three most credible people who have been, beating the drum on we have a debt issue in the U.S. and it's going to lead to, major issues, and they've been singing that tune for 10 to 20 years. Neil Ferguson said in the article, he's like, I'm like the boy who's cried wolf because I've been saying this for 20 years. So it was, I knew where it was going to go. At least I suspected where it was going to go, and I wasn't surprised to see that they all agree that it remains an issue, and they're consistent. You give them credit for that. And they're also reputable, people, professors at Stanford, Harvard, the founder of, I believe, the world's largest hedge fund. I mean, so these aren't random people that they found. These are highly credible professionals, but they have been, ringing the alarm on this topic for a long time. So it's to no surprise they continue to be concerned.
And for different reasons, like Ken Rogoff is focused on higher rates being the issue, right?
Yes.
With these debt levels, higher rates are the primary reason the fiscal outlook is so concerning. He says if rates were to fall sharply, I'd become far less worried. Well, that's reasonable, right? I mean, rates jumping
Yes.
up from here, which you've talked about, makes the debt service payments, a much bigger burden of the budget, and crowds out other investments, limits what you can do. That does seem reasonable to be talking about the risk of higher yields.
It's interesting. Like that was my note on Ken Rogoff, that exact quote. So then Neil Ferguson has a different concern, but that they're definitely related. So he's funny. This is a quote. My personal favorite is what I call Ferguson's Law, a simple heuristic that compares interest expenses to defense spending. The former exceeding the later spells trouble. History is ripe with examples of superpowers that have spent more on debt service than defense, and subsequently were no longer super or powerful. That's exactly the position the US is in today. Although the gross debt to GDP is at its post-World War II level of roughly 120%, America is spending more on interest payments than on defense. So I am very concerned about the US fiscal situation, end quote. So first, it's cute that he names the ratio after himself. But as an aside, it's a different metric, but it's very similar to what Ken Rogoff said, because Ferguson's looking at the interest expense, which is a function of debt outstanding and the rate on the debt. And Rogoff's concerned about the rate on the debt. So it's similar but different but related. So to Ferguson's point, right now tax receipts revenue for the government's about 5 trillion, and the interest expense is about 20% of that 1 trillion. So when the government taxes people and companies and you have 5 trillion in the door, and then you can spend that 5 trillion on infrastructure, you can do social programs, you can educate your population. Those are all things that help build a nation, help build education, wealth. They're productive. Um, Spending $1 trillion on interest expense to debt service is not accomplishing anything. So that's what he's pointing out as a concern, and I think it's valid.
So, Bob, for individual investors, I mean, when would you see this impact markets if we did see rates rising? Beyond what? Like, what would be considered, an elevated 10-year yield that would indicate that the market is concerned about this outside of, these guys writing books about it and naming laws after themselves?
Yeah, the spot where you'd see it is more on longer dated debt treasuries, if you're looking in the US. And we have been seeing the 30-year in particular tick up a little bit this year. So it was as low as about 4.4% in April, and now it's close to 4.9. It's been, dancing around that 5 level. Because when you think about it, this is more of a long-term problem, or long-term concern. So it's looking at the longer end. But yeah, if we see a Fed cut in September, the issue is if interest rates rise. So it's just keeping an eye on that. And if you see the 10-year move, yeah, if the 10 years getting up to 4.5, 5, um, it's a tricky situation because I mean, what a debt spiral, for those who don't know, is it's the math of um, if we can handle a 10-year treasury at 4.25, if it goes to 4.5 or 5, the situation gets harder. Your interest expense goes up. And one thing to keep in mind is the treasury debt's not floating rate. So if today the treasury yields went up by 1%, debt service doesn't change today. It takes time for them to roll debt at the new levels, so it's not an immediate issue. But as treasury debt gets rolled and new treasuries are issued at the higher rates, the interest expense goes up. And then as markets factor in higher interest expenses, then yields go up. And it's a circular issue, hence the debt spiral. So that's the concern. Textbooks teach us to not forecast the direction of interest rates. It's one of the things that really no one does well. So the real scary thing is that, Ken Rogoff's worried about the current level. It's not as if the direction for treasury rates is either the same or lower. It's could be the same, could go lower, could go higher. And the higher risk, I think, is on the table, as I think it would be foolish to assume that they can only go lower from here. And that would be a major issue to the point where it's basically unacceptable. So we're doing okay at current levels, but it's still not sustainable even at current levels. And what I mean by not sustainable is the annual budget deficit. So I mentioned the U.S. takes in 5 trillion. Well, this year they're set to spend about 7 trillion. So that's 2 trillion more going out than coming in. It gets financed with treasury issuance. So it's just piling on more debt and more debt at these rates. So they need to get their house in order and get into politics a little bit. I mean, the way it works is the Fed controls the short end of the yield curve, the Fed funds rate. And think about it like a car, gas and brake, and they're trying to smooth out the economy so that when things are too slow, they do a little gas. When things are too hot, they do a little brake. And higher rates are the brake, lower rates are the gas. That's the Fed, that's monetary policy. There's also fiscal policy, and I think fiscal policy in the US has just been a complete failure over the last 20 years. And they've really put all the work on the Fed. The Fed has shown willingness to increase rates and to cut rates. Like they use both gas and the brake. Congress and the president, they're one pedal drivers. They just use the gas. And it's bipartisan. So if you think about the Trump tax cuts, they're cutting taxes. You go back to Biden. Um, After COVID, there was a big stimulus, and I know Trump started some of that stimulus, but Biden kept it going. And then the Inflation Reduction Act, which was more centered around like EV tax credits. There's more gas than brake, certainly. And then you go back to Trump's first term, and we had round one of the tax cuts. So yeah, and during COVID, they were sending checks out, the PPP program, it's more stimulus. They never raised taxes. They never kind of called that money back. So Congress has done I'd say, a poor job of managing the economy in the sense of, say, raising taxes like Clinton did in the late 90s when we were in a boom. And if we saw, I mean, I don't like paying taxes. I wouldn't be happy to see a tax increase, but I think policy-wise, it's the right thing to do because that's a way of slowing down an economy that's too hot. So it's basically the equivalent of the Fed raising rates, but it brings in more revenue to pay down debt. And because they are not doing that, the Fed's left to raise rates and keep them where they are. So we need some level of political willingness to not run $2 trillion deficits and to raise taxes when they need to and cut spending as needed. And there's just been no willingness to do that in Washington.
Yeah, no, that's true. I would say, as I think about what you were saying, looking at our portfolios, global equities, shorter term, higher quality bonds, some assets that we have in there for inflation protection, regardless. And I don't think that positioning came out of these concerns, but it does align nicely with somebody who would have these longer term concerns. I would imagine.
Yes, nice pivot, getting me off politics and back to investments. The global investing has been the way we've always done it, and the reason is that there's risks in every market. So it's not like we have a global equity portfolio because we're concerned about politics or debt in the US, but those are known risks. And there are risks that are specific to every country, and it's a risk you can diversify. So if you look over time, looking over decades, a portfolio that has equities across multiple countries, you are getting the benefit of diversification, which some would argue is the only free lunch in investing. So why wouldn't you do that? So the global diversification is a big one that's benefiting our clients this year. In fixed income being short to intermediate term, not going too far out on the yield curve where you have more interest rate sensitivity is something we're doing. And then we did increase the allocation to real assets this year, which are more inflation sensitive. So a few different levers that are active in our portfolios to help offset this risk.
Great. Well, Bob, I appreciate that overview. What is your team going to be looking at for the next few months?
Well, we're getting close to capital market season where we reevaluate valuations, asset class expected returns, and like what I just ended on, our allocation to real assets. Where are we today, as an example? Is it the right level? Should we be a little higher? We tend to not make significant moves year over year. We're not moving 10% out of stocks into real assets in a calendar year. It's more on the margin, a couple percent here and there. So something like that, should we be maybe cutting equities a little more, dialing up real assets? That's an example of the conversations we'll be having.
Great. Well, Bob, I appreciate your insights as always. Thank you for sharing with us.
All right, thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kushal Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.